Another area that I found quite interesting from your explanations in the book was your explanation of how, kind of paradoxically, in the fiat standard that we live under, it has benefited people who found the Goldilocks zone of how much debt to have, right? Like, obviously, there were people who were in too much debt and then maybe they were over-levered and they got wrecked somehow. And then maybe the people who had zero debt, they were the ones getting inflated away. So they were the ones losing out, right? If you're saving fiat currency and they're printing more of it, you're losing out. But if you were in that sort of Goldilocks zone, of course, setting aside the moral considerations, it's interesting that in the fiat standard, that's almost the behavior that gets rewarded.
Yeah, that's it, it's kind of that bell curve example. And so because the unit of account itself is depreciating, and because bank accounts and other things are paying interest that is largely below the rate of new money creation, if you're a saver, you're getting your share of the pie is gradually getting diluted, whereas other people are getting expanded. And if even take it a step further, let's say you mostly know this is happening and you decide to buy real assets, but without leverage. So you buy things like real estate, gold, stocks, things like that. The problem there is that those are, for real estate, is taxed on a regular basis plus taxed when you sell, and it's taxed on the nominal gain rather than just the real gain. And same thing's true for equities, although they don't have the recurring tax, they just have like the capital gains. And then the same thing's true for gold, that has a tax at the end. So the government still manages to recoup a lot of the value appreciation for most assets if that asset just mostly increase at the rate of broad money supply growth. Basically, if you invest in Apple at the right time and hold for decades, you're going to vastly outperform money supply growth. If you're a really good stock picker, but if you're, say, buying the index or buying a typical piece of real estate or gold or something like that, you're kind of just treading water after capital gains taxes. And so kind of the one way to really win in that system, if you're not like a top 1% superior investor that always picks the right stocks, is to buy kind of solid things with very inexpensive long-term credit if it's available to you. And that's the more you get wealthy, the more that becomes available to you. And so the kind of the smart thing to do is, if you're going to buy real estate, buy it with a 30-year low fixed rate mortgage and refinance it whenever you can. Buy high quality equities on very low amounts of margin, things like that, because that behavior is what constantly got rewarded. Because kind of like how if you're a saver and you're getting paid an interest rate that is below the rate of money supply growth, you're getting diluted. Well, on the opposite side of that, if you're taking out long duration loans with interest rates that are below the rate of money supply growth, you're basically shorting that fiat currency and you're accumulating real assets, and you're doing it in such you're getting a boost so that you overcome kind of the capital gains taxes and other sort of ways that the government claws back some of the non-leveraged exposures to real assets. And so in that system, access to credit becomes very paramount. It becomes kind of the easiest path towards wealth creation. And then that, of course, benefits those that hand out credit or are kind of closely tied to the system or that have easy access to credit. And then that also ends up applying on the broader scale. So, for example, the whole kind of multi-decade era of private equity was really leveraged buyouts. Basically, a large, well-connected firm that had access to cheap capital would go buy smaller businesses that don't really have access to cheap capital, and they kind of accumulate them under their umbrella and then potentially spin them out with higher leverage in a larger entity. And then you'd also see things like, large hardware stores like Lowe's or Home Depot would be able to kind of eat all their small mom and pop competitors around the country because they had access to much lower cost of capital. And there's, I think, two parts to that. So like one part is just market driven. A larger, more diversified entity is going to have access to lower cost of capital. That's just generally the case. And that's, it's not a bad thing. But a lot of these companies, what they do is they hold debt as a permanent part of their capital structure because they can. So it's like, if you ask, why does Coca-Cola have debt? I mean, they're like a century-old, super profitable, successful company. Why do they hold debt? And the answer is that they're choosing to short the fiat currency for long durations because they can, because that's something that they can do that a small business doesn't really have that same type of
Right.
access to.
It's a competitive
And
advantage for them, and they can hit
exactly,
economies of scale that the small businesses can't.
exactly. And then that's the part of it that only really makes sense in a fiat currency system. So if you had a gold standard or a Bitcoin standard, and there are certain entities that want credit, a larger, safer, more diversified entity is still going to have access to lower cost of capital, but there's no reason to borrow for very long durations because you're buying a unit of account that appreciates versus most things. Whereas in this kind of environment of constant fiat currency dilution, larger entities get extra rewarded by being able to have these kind of permanent, like 30-year shorts on the fiat currency that they keep rolling over at lower rates.
Yeah, and it really changes our behaviors, and I think a lot of people just don't understand this point. So they maybe sort of loosely act in this way because that's the incentive that pushes them that way, but they're not sort of thinking at the level of, oh, I need to be short, I need to be structurally short the fiat currency over the long term. They're not thinking in those terms, of course, like most people. But then that also brings the question, what would it look like on a Bitcoin standard? Does that mean, like our friend Safety, who believes that it's going to be basically a very no or low debt sort of situation? Now, I sort of agree with him. I think it'll be a very low debt, full reserve style credit system, that maybe there'll be some small forms of credit, but maybe not at the same level like we have today, simply because, like we said, the technology, we're post the telegraph, right? Like once we have this technology, it simply won't make as much sense to just be structurally short the fiat currency or structurally short the actual unit of account.
Yeah, I think that the overall credit would be vastly reduced in that type of system. I don't think it'd be zero credit, but I think it would be much reduced credit. And again, you can kind of separate into two types, which is things like debt as a permanent part of a capital structure or long duration debt would make a lot less sense. So, for example, it wouldn't make any sense for Coca-Cola to have, gold denominated or Bitcoin denominated debt on their balance sheet for 30 years. It wouldn't make, governments wouldn't be able to have these kind of like 30-year bonds that they just keep rolling over and just kind of ever growing debt to GDP ratios. It wouldn't make sense to have a house that you buy on a 30-year mortgage denominated in things like gold or Bitcoin. If you look at the average, like let's say the median home, it generally does not outperform gold, especially when you consider maintenance and taxes and things like that. And so you wouldn't short gold and use it to buy a house. You'd only short fiat currency to buy a house. And so in that type of hard money environment, the types of debt that would still exist, I think, would be highly productive shorter term debt. It could be, for example, you're a business and you want to have like a revolving credit line for seasonal changes in your business. That kind of thing is collateralized by the equity of your business. Maybe if you're a homeowner, you want to get a very small loan to do an expansion of some sort. There could be a liquidity provision collateralizing your home with a very low loan to value ratio. If someone wants to get education, I mean, there's multiple ways to do it, but one of the ways could still be, taking on small amounts of credit if you're doing something that's going to probably increase your income substantially. Um, you know, you could have a business expansion where you don't really want to give away your equity permanently, so you're able to secure a little, kind of maybe a 2-year loan that's again collateralized by your business for that expansion. Maybe you're buying a home and you get like a 5-year payment term. That's common in Egypt. I was just in Egypt. They will generally buy homes with like 3-year, 5-year, 7-year installment plans rather than like those 30-year, because no one's going to lend for super long terms in the Egyptian pound for opposite reasons. And so I think there is still credit provision that makes sense in that world, but it's just much smaller because most of those kind of long duration, permanent rolling debt balances no longer make sense, and only high impactful, high rate of return, very safe types of debt are what make sense. And again, and then they wouldn't be fractionally reserved, or at least it wouldn't make sense safely to fractionally reserve them. That would be backed up by capital that is duration matched, or that is kind of permanent capital of a lending institution.
Yeah, good way to put it. And so we can think of it like maybe one way to put it is the borrowing cost in that world will be so much higher. And because of that, there'll be very few projects that, let's say, meet the quote unquote hurdle rate, or the IRR, right? The internal rate of return. That if you're a businessman and you're looking at my project, I'm like, okay, do I do an expansion to build out a new factory? And oh, look, I can see instantly it's going to be very profitable. It's got an IRR of 40%, and I can borrow at 10 or 15%, well, okay, yeah, good. It's a profitable play for me. I should do that. But for most people just buying a home for 30 years, it's not going to be like, they're not going to get that kind of profitability on just simply buying a home to live in. And so I think that may be one way to sort of distinguish, the fiat standard and the debt that exists under the fiat standard and the debt that may exist or is likely to exist under a Bitcoin standard.
Yeah, debt in the fiat standard is a core part of the system because most fiat currency comes into existence through debt creation. And the incentives to have some degree of debt are very high in the fiat currency system. And people that avoid having debt for moral reasons or other reasons end up getting kind of punished for having that view, even though historically that view was often rewarded. Basically, in this environment, savings kind of de-emphasized and having moderate amounts of debt is emphasized because that's what works well over time. Whereas if you had Bitcoin as the base layer of money, that goes back to rewarding savers. You don't have to lend it out to maintain your stack. That's just like an optional thing that professionals could choose to engage in. And the borrowers would not get rewarded unless they're doing something very high impactful, basically engaging in some degree of entrepreneurship or something like that, rather than just making use of the fact that they're able to short something that depreciates over time.